Let's talk markets, the Fed, investing in sports, and much more. Joining us right now is Marc Lasry. He is Avenue Capital Group Chairman, the CEO, and the co-founder, also a good friend of Squawk, and it's great to have you here, Marc.
My pleasure. Thank you for having me.
I want to dig into sports, but let's hold off on that because I think it's probably more important to talk broader markets right now. There's a lot of questions about what's going to happen with the tariffs right now.
Yep.
Those questions didn't seem to do very well for the stock market yesterday because it just means more uncertainty. You're on the record from back in March saying that all of these tariffs would not be good for the economy, that it would be very hard for the economy to survive with them. Have you changed your thought process after what you've seen the last 6 months or so?
I've actually been surprised at how resilient the market is. I really have. But I do think as you have higher tariffs, you just have higher pricing. And the economy has been able to deal with that. So I guess for me, I actually thought if you had higher tariffs, you were going to have lower rates. And you're still a little ways away from that. But everything's about the economy. So if the economy is holding up, tariffs are fine. If the economy isn't holding up, then you better either have lower rates or lower tariffs.
What do you do as an expert in distressed debt? Where do you find things these days? Where are opportunities? Have you been irritated that you haven't been able to find better deals?
Yeah, it's harder. I'm not going to tell you it's not. You need problems. So I think for us, the only thing we're really doing today is more, there's less distress, but you're lending money. People need capital. They need short-term capital. So we've been doing that. You've got more opportunities, I would say, in Europe. You've got more opportunities in Asia. The U.S. market has been really resilient. So I think for us, there's just less to do here.
Who do you lend money to in places like Europe and Asia, and what kind of rates can you get?
You're able to get about, I would say, sort of 12 to 15%.
12 to 15%.
Yeah. People need money. They need short-term capital. So people lend. Nobody can survive if they're borrowing money at 12, 15 for 5 years, right? Everybody, it's more for a year, 2 years until they sort of turn things around. But a lot of it is they've got the assets there. So for us, we're happy to lend. The problem for a bank is a bank's going to look at that and say, look, I only want to lend to you if you've got a certain amount of cash flow. For us, we're happy to do it based on the value of the assets.
Because you get the asset if anything goes awry. If the Fed lowers rates, how does that change that business for you? It
changes it. I mean, you're going to be charging less. I mean, normally what you're doing is you're charging somewhere around sort of 500, 700 over SOFR. So wherever SOFR is, it's the same thing for us.
And I would assume that normally if the Fed's lowering rates, it's because the economy's in trouble somewhere else, so you could swing back into the distress side. Do you see that happening this time around?
I think it takes time. I think rates, if they go down, they'll go down about 50 bips. I don't think they're really going to go down 1% or 2%. So I think the perception is that things are going to be better. People will be able to borrow. You need to have rates go down 1 or 2%, which means that there's real problems in the economy.
Do market valuations at this point make sense to you? We've heard a lot of people saying, hey, it's really expensive right now, but then we have people saying earnings keep delivering.
I think it's expensive. I mean, for what we do, we like to buy things at a discount. I think today it's hard to buy those things at a discount, and that's fine. You just wait. You just have to be patient. I think you get in trouble when you feel like you've got to do things you normally don't do. So for us, if we're not seeing opportunities here, we'll go to Europe, we'll go to Asia. There's always people who need money around the world, and we're a global firm, so we can find that.
We just had the CEO of a Blue Owl on, and we were talking just about how in private equity land, there's so many assets that are just locked up.
Yep.
Nobody can exit anything right now. And there's also a move afoot to democratize private equity and venture capital into 401k plans and other things through these sort of semi-liquid vehicles. And whether this is going to be a great boon and a fabulous thing for retail investors and others, or this is going to be some kind of crazy exit opportunity for private equity folks who've been locked in something to hand it off to those who may not know exactly what's happening?
Look, it's a great question. I think it's hard. I think it's hard to end up having something that is illiquid and very much illiquid, and having private investors come in who love liquidity. That to me is really the issue. It's not being sold, look, give us money and you got to hold on and it'll be fine for 10 years. It's give us capital, that's fine, and we're going to provide you liquidity. Look, to me, you've just got to be logical. If you're giving somebody money for 10 years, you can't expect that you're going to have liquidity next month or next year. And that's what you're having in all these, I think all these programs that are being set up is this perception that you're going to have liquidity when I don't think it's really going to be there.
And therefore, that's going to do what? Oh, it's going to take down this whole alts idea? I mean, does it end well? Does it end badly? I do think long term, you'd think the idea of allowing people in their 401ks to get access to, opportunities that have worked out a lot better for, frankly, wealthy people who've had access to it should be a good thing. But you speak to the sort of the peril of it at the same time.
I think to me, when you're investing in private equity, you're saying, I don't mind having my money locked up for 10 years. Right. I think for small investors, that's just very different. I really do. Because they don't have access to capital as easily. So if there's a problem and they need that capital, they're going to end up having to sell that at a big discount. And there'll be people like me who will buy that at a discount. And ultimately, that's not great for a small investor. That's all.